From the Cube studios in Palo Alto and Boston, bringing you data-driven insights from the Cube and ETR. This is Breaking Analysis with Dave Vellante.
The stablecoin market is rapidly maturing into one of the most consequential sectors of the digital asset economy. After years of uncertainty, regulatory friction, and media skepticism, stablecoins are no longer a speculative curiosity. Rather, they are foundational to the next chapter of programmable finance. Our research suggests that the convergence of policy shifts, institutional adoption, and new economic use cases has thrust stablecoins into the spotlight. In short, crypto's ChatGPT moment has arrived, and its name is stablecoin. Hello and welcome to this week's theCUBE Research Insights powered by ETR. In this breaking analysis, we answer your questions about stablecoins. We'll cover what stablecoins are and why they're relevant. We'll also dig into where they fit in the crypto value chain and what the public policy shifts mean to the industry. Specifically, we'll look at the Genius Act and what it portends for crypto and what's next with the Clarity Act. We'll also dig into what this all means for U.S. Treasuries and finally what the risks are to this whole movement. Now, to help frame this, we're going to draw on an interview from our NYSE Cube studio that John Furrier did with Tom Lee as part of our Cube plus NYSE Wired Crypto Trailblazers series. Now, if you don't know Tom Lee, he's a managing partner and the head of research at Fundstrat Global Advisors. He is by far my favorite guest on TV programs like CNBC and provides next-level analysis on markets and financial trends. Now, for a long stint, he was JP Morgan's chief equity strategist and is the chairman of BitMine Immersion Technologies, which is a blockchain tech digital asset management firm which trades on the NYSE. So we're going to insert commentary from that interview throughout this episode. Now here's the TLDR on all these questions that I just posed. What are stablecoins? Well, they're digital assets and they're pegged to fiat currencies, typically the USD, and they enable low volatility and safe transactions in the crypto ecosystem. Now, the reason they're relevant is you can think of stablecoins as the financial rails of crypto. They power payments, trading, and they provide yield, which drives real revenue and subsequently adoption. We're going to talk about that in some detail. But where do they fit inside the crypto value chain? They're at the intersection of decentralized finance, DeFi, institutional finance, and programmable money, especially on Ethereum, which again, we're going to talk about in more detail. Policy divergence. There's been a big change here. Biden v. Trump, Gensler v. Paul Atkins is totally different situation. Biden and Gensler pushed aggressive SEC oversight and frankly, opacity. Crypto industry executives complained that when they visited Gary Gensler at the SEC and shared their information and the data, the next week they'd get a cease and desist or they'd get debanked. The Trump administration, led by crypto and AI czar David Sachs, are far more crypto-friendly and they're pro-innovation, supporting new laws that bring clarity to the table. And this has created a huge shift in sentiment. It's also created a massive regulatory shift, or maybe as a function of this regulatory shift. So what's changed? Growing clarity and bipartisan support is driving institutional participation, and it's reducing the stigma that crypto is just this big scam. It essentially legitimizes crypto. And perhaps the most significant part of all this is the recently passed Genius Act, which standardizes stablecoin rules across issuers and focuses on reserve transparency and, of course, interoperability. And then there's the pending Clarity for Payment Stablecoins Act, shortened known as the Clarity Act. It's passed committee with bipartisan backing and provides legal routes for banks and FinTechs to issue stablecoins. This is huge because mainstream traditional institutions are getting in on the act. You know, remember when Jamie Dimon threw cold water on the whole crypto industry and then flip-flopped on that issue? Well, this is going to take crypto into hyperdrive. How are stablecoins backed? Well, most stablecoins are backed by short-term U.S. Treasuries that earn yield without passing that yield on to holders, which is something that's really important. We're talking about let's call it 4 or 5% yield. And this is a major incentive for crypto issuers, and we'll talk about that, or stablecoin issuers. What are the implications for treasuries? Well, stablecoin demand is now a meaningful source of U.S. Treasury buying. So this is going to expand the global reach of the U.S. dollar, and it makes treasuries much more attractive because they are the major asset backing stablecoins. And there are other real-world assets, RWAs, like securities and art and physical assets and even real estate. Real estate in particular is more complicated, primarily because it's less liquid, but the tokenization of RWAs is real. You remember that NFT craze when people got 69 million for his digital art? We did a breaking analysis on that. Well, the idea of tokenizing real-world assets, it's back in vogue, and this promises a lot less friction in asset sales. Risks and critiques. Regulators are rightly concerned about protections for consumers and inadequate oversight, especially of international stablecoin providers. They're worried about a run on stablecoins, and basically these institutions running out of money. There's regulatory arbitrage. We're going to talk about that, especially because there's state-level loopholes. And reserve quality. There's also systemic risk from concentration and too big to fail dynamics, which we'll talk about in some detail. Now, despite all the enthusiasm, which is awesome, we've seen this before where the regulatory pendulum swings toward less oversight, which invariably leads or can lead to bad behavior and often market meltdowns. So we're going to look at that a little bit as well. All right, let's dig in a little bit more to each of these questions. Let's start with what are stablecoins? As you said, stablecoins are digital assets, and they're pegged to the value of fiat currencies, most commonly the US dollar. Now, unlike cryptocurrencies, such as Bitcoin or Ethereum or Solana, which are highly volatile, stablecoins, they maintain a steady price because they're backed with reserves, either in fiat or other cryptocurrencies or algorithmic mechanisms. We'll talk about that as well. So you can think of stablecoins as the grease in the wheels of crypto markets. And they enable real-time trading, they enable payments, and increasingly on-chain financial services. Now, according to Tom Lee, stablecoins and the recent change in attitude from public policy has created what he called, and we stole at our intro, the ChatGPT moment for crypto, and has become a catalyst for broader institutional acceptance. And is also a growing revenue engine for banks and platforms. Let's listen to Tom explain his point of view on this. Please play the clip.
At Fundstrat, we've been recommending Bitcoin and Ethereum for about 8 years. And most of that 8-year journey, when Bitcoin was under 1,000, was that crypto was not considered legal or legitimate. And it fought a constant uphill battle to get regulatory recognition. But in the past year, that has completely transformed. And now crypto is not only being embraced by the government, but the banks are really running into crypto now. And they're embracing it because they're making money off the ETFs, but also because the stablecoin business has become the ChatGPT moment for crypto. It's been widely adopted by consumers and merchants, and now banks want to offer stablecoins. And most of that's taking place on Ethereum. So Ethereum, from talking to my institutional clients, has become the biggest macro trade for the next 10 years.
Now, for those not familiar with the premise behind Ethereum, let me explain it briefly. Bitcoin is often referred to as a store of value or digital gold. You hear that all the time. You buy it and you hold it, but it doesn't really have much utility in terms of enabling new technologies or supporting the development of new markets like decentralized apps, what people call DApps, or supporting exchanges of goods and services via smart contracts. Bitcoin is not programmable. Ether is. The primary programming language for developing smart contracts on the Ethereum blockchain is called Solidity. It's an object-oriented language, and it's purpose-built for building smart contracts that run on the Ethereum virtual machine. We've talked about this in previous breaking analyses. Its syntax is a lot like C++ or Python or JavaScript. It makes it relatively easy for developers who are familiar with these languages to use it. Now, of course, Gen AI is going to make programming Ether even easier. So Ethereum's founders Vitalik Buterin and Anthony DiOrio, who is, by the way, a CUBE alum, and others had the vision of creating a blockchain platform that was programmable and then could execute smart contracts to build decentralized applications. And this is all gaining new momentum in the market thanks to the new administration and some technology advancements and, of course, AI. Okay, so why are stablecoins relevant and why today? So stablecoins represent a bridge between traditional financial systems and the decentralized future. Their relevance stems from 4 factors that we're showing here, and we're going to dive in a bit deeper. Let's first look at financial infrastructure and modernization. Stablecoins are really useful because they reduce friction, particularly in cross-border payments. This has been a dream in finance forever. That is enabling 24/7 by 365 settlement, quickly, nearly instantaneously with very low fees. Second, let's talk about dollarization and monetary policy. As Tom Lee noted, this is a dollarization story, he called it. Stablecoins have become a global flashpoint for U.S. dollar influence. The third is programmable yield and treasury replacement. Ethereum-based staking and yield generation now give viable alternatives to traditional fixed income strategies. Ethereum staking is where you lock up your ETH to help secure the Ethereum network and earn rewards in return. It's a core part of the proof of stake consensus mechanism that Ethereum uses. By staking your Ethereum, your ETH, you become a validator responsible for verifying transactions and adding new blocks to the blockchain. And simply by holding the asset, you earn returns that are typically better than fixed income instruments. So if you own Ethereum, you get the upside, and you're subject to volatility. But if you stake that Ethereum, you earn a return that is, generally somewhat better than bonds. The fourth point here is institutional entry points. Banks and asset managers are entering the space through regulated stablecoin products. And this is a game changer because it's flipping the script on safety and stability of crypto. Listen to Tom Lee responding to John Furrier's question in his explanation of the economics behind staking. Play the clip.
That dynamic, because I think that is probably the most misunderstood factoid out there, is that there's actually real value being created.
Stablecoins are a hugely profitable business because Circle is showing it, because they don't pay interest and they're earning 4% on their reserves. Coinbase is a very profitable company. It's done very well. But the Ethereum treasury companies are very profitable. When we do native staking, we're going to earn more than 4% native staking yield. So on the current Ethereum held, and we haven't disclosed what it is as of now, this minute. We've disclosed what we had yesterday. It's about a $100 million net income business.
Okay, so where do stablecoins fit in the crypto world? Stablecoins, they operate as the foundational layer of liquidity in the crypto ecosystem. So they're integral to decentralized finance and centralized exchange, CEX operations, in emerging use cases like tokenized real estate and equities. Although I'm less bullish on real estate as an asset backer for stablecoins, as I said before, the inherent lack of liquidity. But over time, maybe that'll evolve. Real estate will evolve as a real world asset that will be backing stablecoins. I mean, it is today, but it's just less popular, obviously, than the US dollar. In Lee's words, Ethereum has become, quote, the biggest macro trade for the next 10 years. I mean, think about it. Crypto is arguably the greatest asset in the history of asset classes. Now, this is because the dominant substrate for stablecoin deployment and smart contract innovation is, of course, Ether. Now, back to the earlier point we made on the original premise of Ethereum. Let's listen to Tom Lee's explanation on this topic and where we are today. Play the clip.
First, Bitcoin and Ethereum should be friends, because I think the community tends to be really fractured. There's ETH maxis or Bitcoin maxis, but Bitcoin really is proven itself to be digital gold. A real store of value and a good way to move and actually move quite a lot of money pretty simply and move a lot of value. But Ethereum, as you said, is programmable. It is really robust. The uptime is better than any other layer 1 blockchain, especially with smart contracts. And so that's where Wall Street is coming in and saying, you know what, I want to tokenize a dollar, that's the stable coin. I want to tokenize real estate. I want to tokenize equities. Most of that is taking place on Ethereum. JP Morgan's choosing it, Robinhood. And that has led to the price recovering from 1,700 to 3,800. It's still below the 6,000 from 5 years ago. And if you inflation adjust it, it's like 9,000. So Ethereum is still super cheap.
So goodbye.
Okay, now let's shift focus. Let's dig into public policy and the change from enforcement, the previous administration, to engagement. The Trump, Sachs, and Atkins, and how they shifted the regulatory posture. So the transition from the Biden-Gensler regime to the Trump, Sachs, Atkins leadership, it really marks a clear and deliberate pivot in U.S. crypto policy. It's really profound. And so from an enforcement standpoint, it's an enforcement first posture in the Biden administration has shifted to a market and crypto friendly framework, which is aimed at better clarifying and the rules of the road, and of course sparking innovation, making the U.S. the central point for crypto innovation. If you remember, under President Biden and former SEC Chair Gary Gensler, as you've heard me complain many times on the Cube Pod with John Furrier, they pursued an aggressive enforcement agenda, asserting that most digital assets qualified as securities under existing law. Gensler's tenure, was marked by high-profile lawsuits, a lot of what people complained about, regulatory ambiguity, which I agreed with, and a very chilling effect on U.S.-based crypto innovation. The Gensler era, it framed the industry largely through the lens of investor protection and systemic risk. Now, that's not all bad, by the way, but they had zero focus, in my opinion, on innovation, on U.S. competitiveness, and absolutely no vision for the future. By contrast, the Trump administration has gone to the other end of the spectrum. The appointments of David Sachs as the AI and crypto czar and Paul Atkins, who was confirmed as SEC chair in April of this year, it's introduced a dramatic shift in tone, in substance, and in vision. Sachs is an entrepreneur, of course, and an innovator, while Atkins is a known proponent of light touch regulation and market-driven oversight. So under this regime, we expect the following. And where the new administration is there, first of all, prioritizing the development of clear regulatory definitions for digital assets. And this is critical because it distinguishes between things like commodities, securities, and stablecoins. This is something that Gensler refused to address during the Biden administration. Second, this can encourage stablecoin innovation in the form, as an example, of public-private models for compliance and creating transparency in reserves. Previous administration policies, what they did is the policy forced stablecoin providers to leave the U.S. and domicile in places that maybe didn't require as much transparency, and this was bad policy in our view. And also, stemmed innovation or catalyzed innovation overseas, not in the U.S. Next point is this administration is reducing the role of regulation by enforcement, and instead they're favoring clear rulemaking and guidance, which we think will foster growth. Hopefully it'll be responsible growth. Grow responsibly. Finally, there's closer coordination between financial agencies like the Commodity Futures Trading Commission and the U.S. Treasury, such that these agencies can align to a unified digital asset strategy. So all this, in our view, this leadership transition signals a green light for financial institutions, FinTechs, and crypto-native firms that want to operate within clear, predictable rules, something that Coinbase has been pushing for a long, long time, and others in the crypto industry. It also aligns the U.S. more closely with jurisdictions like the UK, the UAE, and Singapore, which have already implemented forward-leaning crypto frameworks. But this is very important because stablecoins will be backed by the world's reserve currency, i.e. the U.S. dollar. It creates this virtuous dynamic cycle for the U.S. dollar and for its treasuries. And this is why Tom Lee calls stablecoins in the recent legislation the ChatGPT GPT moment for crypto. So as we enter the second half of 2025, We think the regulatory bottleneck that once constrained the U.S. crypto industry and the U.S. leadership is finally breaking loose. And this is going to usher in a new era of digital asset legitimacy, capital formation, and competitive positioning for the dollar. So let's look at the regulatory evolution and how it's shaping attitudes toward crypto, which have changed significantly. What was once considered this fringe asset that a lot of people were afraid of, and you certainly heard Elizabeth Warren and Warren Buffett, share their concerns, but it's now gone mainstream. I mean, it helped get Trump elected. Wall Street is not only buying crypto assets, but they're building infrastructure around them. So the legitimization is not only regulatory, it's becoming cultural in our view. So you're seeing the listing of crypto firms like BitMine, which is Tom Lee's listing, which is on the NYSE. As Tom Lee noted, it sends a very powerful signal that traditional finance sees crypto as credible. Total, like I said, flip-flop from Jamie Dimon's original posture on this. Here's Tom Lee's take on the credibility of crypto and why the NYSE. Please, play the clip. All right, let's look a little bit about some of the legislation. What is the Genius Act? Well, the Genius Act stands for, people know this, I didn't know it until I did this research, the Guiding and Establishing National Innovation for U.S. Stablecoins Act. That's a mouthful, but it works. It's a U.S. law that establishes the first comprehensive regulatory framework for stablecoins, and what it aims to provide is clarity and consumer protections, we'll talk about that a little bit, within the stablecoin market, fostering innovation and potentially strengthening the U.S. dollar's position as the world's reserve currency. So the bill was signed into law on July 18th of this year by President Trump. So why is the Genius Act important, and what are the key provisions in the act? So first of all, this is the first comprehensive federal stablecoin regulation ever. And the U.S. has operated without a unified national law specifically governing stablecoins, which has led to this patchwork of inconsistent state rules, which is just foolish. The Genius Act aims to provide clarity and uniformity, which ostensibly is going to reduce regulatory uncertainty for issuers and financial institutions and, of course, consumers alike. The second point is consumer and financial system protections. This is very important and is really a source of controversy that we'll talk about at the end. By imposing reserve requirements and explicit rules for redemptions, the Act hopes to reduce risks such as issuer insolvency, bank runs, banks running out of money, and consumer losses that have been major concerns in the rapidly growing stablecoin market. We'll come back to this at the end. Some people think it doesn't go far enough, but it's certainly a positive starting point. The third point is we're trying to the Act is trying to encourage responsible innovation. So it allows both banks and qualified non-banks, again, this is controversial, this includes technology companies, to issue stable coins, which could potentially foster competition and innovation in digital finance. So it seeks to balance growth in the stablecoin sector with safeguards for market integrity. And this is what is somewhat controversial, as I said, and we're going to talk about the risks later on. The fourth point is that it's addressing systemic risk and market integrity as stablecoins are increasingly used in payment systems and remittances and decentralized finance. The Act addresses these risks by ensuring that issuers are subject to ongoing supervision and that the underlying assets are transparent and secure. Again, some of the naysayers are saying it has not gone far enough. Okay, so this leads us to the status of the Clarity Act, which has not been signed into law yet. The Clarity for Payment Stablecoins Act, otherwise known as the Clarity Act, it recently passed out of the House Financial Services Committee with bipartisan support, by the way. It defines payment stablecoins and sets reserve requirements, audit standards, and registration paths. And so this bill is really important. It differentiates stablecoins from securities and provides a lawful on-ramp for banks and FinTechs to issue them. So they're going to be joining the party, and that's going to make a lot more people a lot more comfortable. So if passed, the Act will likely accelerate institutional adoption and reduce regulatory uncertainty, making it a foundational piece of the crypto policy framework. Now, the Genius Act and the Clarity Acts are different. How so? The Genius Act focuses narrowly on the regulation of payment stablecoins, and the Clarity Act provides a broader market structure for digital assets that are not stablecoins, for example, cryptocurrencies and tokens. So the Clarity Act seeks to clarify, it's the name, the distinction, the regulatory treatment, and supervisory rules for all digital assets that may be classified as commodities or securities or fall under other regulatory categories. Let's look at how stablecoins are backed, because this is really important. Stablecoins like USDC, which is issued by Circle, are backed by short-term U.S. treasuries and cash equivalents. The business model is simple but super powerful. So the way it works is issuers collect deposits and they invest them in T-bills that yield somewhere, let's call it 4%, and return none of that interest to holders. So as Tom Lee said in an earlier clip, Circle doesn't pay interest and they're earning 4% on their reserves. And he says he's earning $100 million in profit each year in his fund. So this has created a massive cash flow opportunities, making stablecoins functionally similar to money market funds, but with all the benefits of native blockchain, like low friction and when you're moving money, and there's no trusted third party required, and lower fees, and immutability of the blockchain, and all the other sort of inherent benefits of blockchain. So what does this mean for U.S. treasuries? This is also another really interesting angle of this story. Stablecoins are becoming significant marginal buyers of U.S. treasuries. So as adoption scales, the demand for T-bills is going to go through the roof, and this supports treasury market liquidity, which has been under fire lately or has been a big concern. As you see, the rates rising to create more demand. So it extends also the dollar's influence globally, particularly in emerging markets where dollar-pegged stablecoins often outcompete local currencies. Check this out. Listen to Tom Lee. He's going to explain this dynamic that I just mentioned using Bermuda as an example. Please play the clip.
An example is, you probably don't realize, have you been to Bermuda?
Yeah.
Okay, and you use Bermudian dollars, right? Mm-hmm. That's a stable coin because the central bank does not guarantee that rate.
Really?
There is nothing backing a Bermudian dollar, but it's still equal to a dollar.
So we are already kind of living it.
So Circle is more secure than a Bermudian dollar. I'm not trying to offend Bermuda, but...
Okay.
So in our view, this reinforces U.S. economic sovereignty through digital financial infrastructure and represents an underappreciated geopolitical tailwind, or increasingly it's being appreciated. In short, the passage of the Genius Act has major implications for the U.S. Treasury markets, primarily because it requires permitted stablecoin issuers to fully back their tokens with very high-quality liquid assets, most notably U.S. Treasuries and cash equivalents. Two things we'd call out in terms of the impact on U.S. Treasuries. First, this creates, as we said, increased demand for Treasuries. Stablecoin issuers are now mandated to maintain reserves in cash or short-term U.S. Treasury securities. And as the stablecoin market grows, potentially into the trillions of dollars, which we think it will, these issuers will become significant purchasers of treasuries. JP Morgan analysts have projected that stablecoin issuers could soon be among the largest buyers of treasury bills, ranking alongside major foreign holders like China and Japan. The second point is this reinforces dollar and treasury hegemony. By establishing a robust regulatory framework and making U.S. dollar stablecoins more globally attractive, the law supports the continued centrality of U.S. treasuries as a safe global asset. So this will likely support the demand for dollars and treasuries, especially for cross-border payments and international investors that are seeking more regulatory certainty. All right, let's pivot to some ETR data and tie this into some of the spending data that ETR tracks on the FinTech sector. They've added this recently, maybe a year ago or so. They added FinTech as one of the sectors, along with the other 18 or so, almost 20, I think they track now. So we're going to do so with this two-dimensional graph that we're showing here that plots a number of FinTech platforms spending velocity on the vertical axis and market penetration or pervasion is on the x-axis. Let's just focus on Stripe's leadership and make a point. Stripe's strength is a signal to us. It's a signal that institutional validation for crypto rails is coming. So this ETR peer chart is from July 25. It shows Stripe with the highest net score, almost 40%, which is that magic 40% line, and the broadest shared account footprint, which is almost 12% among FinTech vendors. So you can see it's up and to the right, well ahead of legacy platforms like Intuit and Fiserv and Bill.com. Although those guys can play as well. This positioning reinforces a key thesis in today's breaking analysis, i.e. the crypto economy is rapidly merging with mainstream FinTech infrastructure, and firms like Stripe are emerging as a primary conduit. So Stripe's strong momentum reflects enterprise demand for programmable payments, embedded finance, and crypto on and off ramps, all of which are foundational to stablecoin adoption and blockchain-based settlement rails. And its integration with stablecoin networks like USDC aligns with the regulatory thawing and strategic focus that we now see under the Trump-Sachs-Atkins regime. The second point is Stripe's lead in this data set represents not just tech strength, but early mover advantage in offering compliant crypto-native services to institutional clients. So in our view, this validates Tom Lee's assertion that stablecoins are the ChatGPT moment for crypto, and that banks and fintechs are now racing to offer Ethereum-based stablecoin solutions, which is a narrative that Stripe is helping operationalize at scale. All right, all that said, let's look at some of the risks and criticisms around some of the changes in public policy. While we're really bullish on the recent policy changes toward crypto, we don't want to ignore the fact that often relaxed regulation leads to financial meltdowns. Here's a quick look at some of the disasters and crises of the past. The S&L crisis in the 1980s stemmed from the relaxation of real estate lending regulations and put over 1,000 banks out of business. It was a disaster. And then, of course, the taxpayers paid over $100 billion for that. And then there was the long-term capital management collapse in 1998. It can be traced back to the lack of hedge fund oversight. And when LTCM went rogue, the system nearly collapsed. Back in the dot-com, in order to do an IPO, all you had to have was a web domain and a prospectus. I'm oversimplifying, but the accounting rules were relaxed. And that led to trillions in lost market value, 5+ trillion. Some of you might remember Enron and WorldCom. Essentially, they had fraudulent accounting, and that led to Sarbanes-Oxley. And the 2008 financial crisis can be traced to deregulation and packaging crappy assets into derivatives. Easy money lending policies were overlooked by regulators and the rating agencies, and that led to a prolonged global recession, very painful for a lot of people, and a fundamental change in economics in this country. It took a long, long time for the markets to rebound. Now, for what it's worth, the S&L crisis was pushed by Republicans under the Reagan administration. The lack of regulation that led to the long-term capital management and dot-com meltdowns, they were bipartisan, as was the derivatives deregulation that led to the 2008 financial crisis. That was approved by Republicans in Congress and signed by President Clinton. And the weak accounting controls that led to the Enron and WorldCom fraudulent reporting was a George W. Bush era initiative. At any rate, despite the wonderful tailwinds, many feel the stablecoin ecosystem faces substantial risks. Here we highlight 4. Regulatory arbitrage. And so fragmented global policies could lead to what we say here, a race to the bottom. What does that mean? So regulatory arbitrage happens when companies or investors move their business to countries with the weakest rules just to avoid stricter oversight elsewhere. Since different countries have different crypto laws, some may offer looser regulations or lower taxes to attract businesses. And this can create a race to the bottom where countries compete by weakening their laws, which can lead to less transparency, more fraud, and higher risks for everyone, especially uninformed consumers. Reserve transparency. Not all issuers are equally transparent or compliant. There will invariably be bad actors trying to game the system for short-term gain that could create the domino effects in the economy. This is what people mean by systemic risk. Stablecoins backed by volatile or synthetic assets like algorithmic stablecoins can trigger market-wide instability. So systemic risk means that one failure can cause everything to start breaking down like dominoes falling. In the case of stablecoins, some are backed by risky or made-up assets instead of real dollars or safe government bonds. For example, algorithmic stablecoins, which I just mentioned, they try to stay stable using computer code and trading tricks to stay ahead. But if those systems fail, remember the flash crash? The stablecoin can suddenly lose its value. And if that happens, it can shake confidence across the entire crypto market, causing prices to crash and other companies to fail, just like how one bad bank can trigger a financial crisis. You remember the Jenga blocks in the movie The Big Short? It's like building the foundation of a skyscraper out of Jenga blocks. It might look stable for a while, but if one piece shifts, the whole building can collapse. Then there's concentration risk. If there's dominance by a few players, Circle, Tether, JP Morgan, it could stifle innovation and create these too big to fail scenarios where taxpayers have to bail out the system. And as Tom Lee explained, clear backing is essential. And he said to John Ferrier, quote, "As long as people are backing their reserves, there is no risk." That's what the model is. Hey, I like his optimism, but I always worry about blind spots. But generally, we're super positive. Now, he also noted that the irony is that many existing fiat-pegged currencies, like the Bermudian dollar, operate with far less transparency or backing than modern stablecoins. Hence, these stablecoins are more stable than many existing currencies. So, just to close, despite the risks, in our opinion, stablecoins are no longer the speculative playground of crypto insiders, zany crypto enthusiasts. They're becoming mainstream instruments of economic policy, institutional strategy, and programmable finance. The regulatory fog is lifting and clarity is emerging. And as lawmakers, investors, and financial giants converge around stablecoins, we think this is not merely a trend, it's an inflection point. Crypto has had many moments, and this one feels different. In a tip of the cap to Tom Lee, this one has yield. Okay, that's it for now. Thanks to Alex Meyerson and Ken Schiffman on production and in our podcast, and Kristen Martin and Cheryl Knight, who helped get the word out on our social media and in our newsletters. Rob Hoth is our EIC over at SiliconANGLE. Does some great editing. Thank you all. Remember, all these episodes are available as podcasts. Wherever you listen, just search Breaking Analysis Podcast. I publish each week on thecuberesearch.com and siliconangle.com. You can email me at david.vellante@siliconangle.com or DM me at dvellante or comment on our LinkedIn post. And please do check out etr.ai, best survey data in the enterprise tech business. This is Dave Vellante for theCUBE Research Insights powered by ETR. Thanks for watching, everybody. We'll see you next time on Breaking Analysis.